Hello and welcome to our channel. Today we'll be talking about a question that many HDB buyers face, choosing between a HDB loan and a bank loan. Let's break down some of the key factors that you should consider. In this channel, we'll be talking about different real estate topics that will guide you through your first purchase. My name is Daryl and I've helped others through this journey, and I am sure I can help you too. I am not a property agent myself, so you can expect impartial advice from this channel. In this video, we'll be doing a comparison of the mechanics of the two loan types. We'll walk through an example and how the numbers will differ depending on whether you choose a HDB loan or a bank loan, and then we will walk through some closing thoughts. So stay tuned to the end if you want to find out what you should really be thinking about. Alright, so let's start with the mechanics. The down payment is perhaps the first major component that you need to think about before choosing between a HDB loan and a bank loan. For a HDB loan, you only need 20% down payment, and this can be made up of either cash or CPF. For a bank loan, however, you need a total of 25%. 20% can either be from cash or CPF, while 5% needs to come from cash directly. In terms of loan tenure, which is the duration of your loan, for a HDB loan there is a maximum of up to 25 years. For a bank loan, on the other hand, if you qualify, you can go up to 30 years. Another very large component that you need to consider is the interest rates. For a HDB loan, you have a fixed interest rate of 2.6% as of the time of recording in April 2024. The interest rate of a bank loan, however, is variable. That means that it depends on when you start the loan, what package you sign, and this number is also subject to change throughout the entire tenure of your loan. The number that you see at the start may not be the number 5 years down the road or even 10 years down the road. A HDB loan does not have any refinancing option. This means that what you see on day one is more or less fixed until you pay off the loan, with the exception of an early repayment. Bank loans, on the other hand, has the ability to refinance. This allows you to capitalize on lower interest rates. That being said, if the interest rates go up, this may hurt you as well. Choosing a HDB loan at the start will allow you to switch to a bank loan after. If you choose a bank loan at the start, however, you will not be able to switch back to a HDB loan afterwards. In the event that you have accumulated some savings and want to repay a portion of your loan early to save on the interest, both routes allow this to be done. For a HDB loan, you can do a partial repayment with a minimum of $5,000 with increments of $1,000. That means $5,000, $6,000, $7,000 and so on. For a bank loan, however, if you do a partial repayment during a lock-in period, which is typically anything between 1 to 5 years, but it's usually about 2 to 3 years, there is usually an admin or penalty fee. This penalty is usually about 1% of your loan outstanding, and this is the penalty for breaking the lock-in period of your loan. If you do it after the lock-in period of your loan, there is usually no implicit charges. The same conditions apply for an early repayment / full redemption of your housing loan. In terms of eligibility, a HDB loan is slightly more stringent. It has an income ceiling of $14,000 per month and $21,000 for extended families. It requires at least one buyer to be a Singapore citizen, and you can only take a HDB loan up to 2 times in your life. Do note that both loans are still subject to MAS regulations, such as the TDSR and MSR, to ensure that you're not over-leveraged with respect to your monthly income. If you're not sure what the TDSR and MSR means, you can do a quick Google, or leave me a note in the comment section below if it's something you would like me to explore in the following video. Finally, you will need a lawyer in both circumstances, what we call a solicitor, to represent you in your purchase. If you take a HDB loan, you can choose to either use HDB as your lawyer, or you can engage a private law firm. If you choose a bank loan, on the other hand, the only option you have is to go with a private law firm. Now let's walk through an example of a home purchase and see what the numbers look like for both options. We'll use the example of an 800K unit to talk about the numbers for both options. For this example, we'll ignore HDB grants for now, as that will only add complexity to this example. When it comes to your actual purchase, however, just note that the HDB grants can be used to offset your down payment. If you are taking a HDB loan, your minimum down payment will be 20%. This will be $160K, and it can be paid in either cash or CPF. If you stick to the minimum down payment of 20%, your loan to value will be 80%, and that means your loan quantum will be a total of $640K. If you take the maximum tenure, which we will use in this example, that will be 25 years for a HDB loan. With an interest rate of 2.6%, your monthly mortgage would come up to be $2,903. So far in this example, the two most important numbers you need to note are firstly, your down payment, and secondly, your monthly installment. If you want to scrutinize, you can also look through the interest component of each month and how it adds up to the total interest payable throughout the duration of the loan. This may or may not be important depending on how soon you intend to pay off the loan. The best way to do this is using a compound interest calculator or a mortgage loan calculator. I will link that in the description below. Do note here that the monthly installment may be slightly different for your case, depending on how much you have down paid. In many cases, the HDB down payment is not entirely within your control. After you have received your grants, HDB will typically wipe out your OA and only allow you to keep up to $20K. That would be your down payment. This can result in you paying more than the minimum down payment of 20%, which in turn means that your monthly installment will be slightly lower than the number that you see on screen here. On the bank loan side of things, your minimum down payment will be 25%. This will be $200K, which is slightly higher than the HDB loan option. For this $200K, $160K can either come from your cash or your CPF, but $40K needs to come from your cash directly. If you stick to the minimum down payment of 25%, your loan to value will be 75%, and your loan quantum will be 640k. If you are able to and you do take the maximum tenure, that means your loan tenure will be 30 years. You can see here that I noted 2 different interest rates and 2 different monthly installments. This part is actually something very crucial to note if you're deciding between a bank loan and a HDB loan. The reason for this is that there is no guarantee what the bank interest rate will be. Even if you're able to secure a good rate today, this rate is almost guaranteed to change over the duration of the loan. The frequency of change will be very much dependent on the type of loan you take. Is it a fixed rate or is it a floating rate? And the duration that you choose to lock in for. But choosing a bank loan is a whole different topic and we will not go into that in this video. For this video, just note that the interest rate that you have on day one is likely not going to be the interest rate throughout your entire loan. Let's take a quick look at how interest rates have changed over the course of a few years. Again, just a quick note that this is some of the interest rates that I have personally observed over the few years. Of course, the specific bank interest rates depending on the banker you talk to, the bank you talk to, and the kind of package you choose. But I'm just using this to illustrate how that number can change over the course of a few years. So in short, this is just an example from my own experience. As you can see, the bank loans interest rate started off lower than the HDB loans interest rate. We have 1.3% versus 2.6%. Some background here is that this was during the era of quantitative easing by the US Federal Reserve, which was spurred on by COVID. Overall, this brought global interest rates down, and this also impacted our housing and mortgage interest rates. However, as you can see, I've assumed a 2 years lock-in, and after this 2 years of lock-in, when it came time to refinance for a bank loan, the interest rate actually went up to 3.2% in the year of 2024. And this is now higher than HDB's 2.6%. Where it would go in the future is really anybody's guess. You could make a speculation, but the truth is that nobody knows for certain. Back to our example again, if you sign a home loan at 1.3% interest rate, your monthly installment will be $2,014. However, when the interest rate rolls to 3.2%, your monthly installment would then be $2,595 per month. So you can see that even at 3.2%, the monthly installment is still lower than that of HDBs. If you're wondering why, this is because a bank loan has a lower loan to value. What that means is that the loan quantum that you're taking from a bank is slightly lower than the loan quantum that you would take from a HDB loan. And furthermore, a bank loan allows you to stretch a loan duration out for a longer period of time, 30 years versus the 25 years of a HDB. So now that you understand how both work, let's answer the question of which is better. Let's start by looking at the list of the different pros and cons. In my opinion, not every factor is created equal. So some factors are more important than others, and let's take a first step by tracking off those that are not as important first. As a disclaimer, this is what I personally think is important. If you feel that I've missed anything out, or if you have a differing opinion, feel free to let me know in the comment section below. First and foremost, let's assume you qualify for a HDB loan, otherwise we would not be talking about this in the first place. Next, in my opinion, the option to do a partial repayment and an early repayment is not so important as well. Many reviews online, in my opinion, overstate this. It is true that you have some limitations for a bank loan, but you actually do have a lot of flexibility to either do a partial repayment or to do an early repayment after your lock-in period. As I mentioned earlier, your lock-in period is typically within 1 to 5 years, but more often about 2 to 3 years. Furthermore, for most of us, we will not think of doing an early repayment during the first few years. Even if we did and we wanted to do a repayment, we can always wait for the lock-in period to be over. Or at the very worst, you still have the option to do so, but you incur a 1% admin or penalty fee. So to sum it up, I don't think this is a top consideration. The lack of refinancing capability by itself is not a major downside, because even though you don't have the ability to refinance on a HDB loan, you're actually enjoying a very competitive interest rate of 2.6%. Just a quick comment on the 2.6% HDB loan interest rates. Depending on the time you make your purchase, you may either think that 2.6 is very high or very low. But actually, if you take a step back and look at things on the grand scale of things, 2.6% is actually considered very low. It is only in the recent era of quantitative easing, where the Fed has brought interest rates down, that 2.6% appears to be high. I don't think that the option to choose your solicitor is a very big differentiator too. A HDB lawyer may be slightly cheaper, usually by about 1k, but on the grand scheme of things, this 1k is not as important as some of the other factors that you should actually be considering. So after striking off some of the less critical components, we are now left with the down payment amount, the loan tenure, the interest rate, and the ability to switch between the two. You can look at the pros and cons for yourself, but in my personal opinion, in today's context, a HDB loan is a clear winner. With the HDB interest rate being lower than the bank's interest rate, we have almost no reason to go for a bank loan. But you may ask, what happens if I watch this video slightly later and the bank interest rate is actually now lower than the HDB interest rate? What should I choose? So one thing that you need to know is that the bank's interest rate is variable. Just because it is lower than the HDB interest rate at the time of a purchase, it does not mean that it is always going to be lower than your HDB interest rate. In short, a bank's interest rate is variable throughout the years. I think it depends on your outlook on where interest rates will be in the foreseeable future. If you think that in the long term interest rates will be below 2.6% and you have the appetite to speculate, then maybe a bank loan is something that may be more suitable for you. However, for the majority of us who do not know or do not care and have no clue about where interest rates will be going, or for those of us who acknowledge that it cannot actually be predicted and you do not want the uncertainty, then a HDB loan may be more suitable for you. Firstly, it gives you the guarantee that you need. You can foresee your cash flow for the entire duration of the loan. You know how much you'll be paying for your house for the next 25 years, every month. And with this number, you can then make plans on it. You do not need to worry about it changing, and you have full certainty on what your monthly installment will be for the next 25 years. The downside here is that you may end up paying slightly higher interest for the periods where the bank interest rate is lower than 2.6%. And to that point, I think you have to ask yourself if that price is worth paying for a peace of mind. Secondly, if you take a HDB loan today, and if you decide to switch your bank loan in the future, you can do so. But the inverse is not true. If you take a bank loan today, you cannot switch back to a HDB loan. So the decision to take a HDB loan is reversible, but the decision to take a bank loan is not reversible. So there you have it. If you want a peace of mind, choose the HDB loan option. If you're able to afford a slightly higher down payment, and you feel that in the long term interest rates will be lower than 2.6%, and if you're open to the speculation, then you may want to consider a bank loan. I hope this was helpful. If you want more unbiased property tips, consider subscribing to the channel. See you next time. Bye!